The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome on back here to the Diagnostic Trading Hour. And let's go ahead and check out where the markets are at right now. They're plunging on back down. We got the S&P down 25 points. We have the Nasdaq down 55. We have the Russell down 20 and the Dow down 149. Gold is down 9 points, along with silver is down 1.6%. We got copper down over 3.5%. Oil right now down $2. So commodities and indices both simultaneously getting crushed right now, down almost 2.5% on oil. We got corn, it's moving in the shake. It's down a whole 1.5 points. We got the soybeans that actually is moving. It actually decided to go ahead and go up today. Right now it's up $13. Euro dollar is down 152 pips. So just closed out a euro dollar trade for profit there. Went pretty well. And just right past that 2 deviation level. And looking on at pound dollar, down 126 pips. And we got Aussie dollar down 107. Looking over at euro yen, it's down $1.56. Pound yen down $1.42. And U.S. yen down 8 ticks on the day. U.S. Canadian's up 60 pips with U.S. franc up 109. So definitely a strong dollar, king dollar ruling the day right now. Indices and commodities both just plunging on down. And it is a wild ride out there. It's a trader's market. And this kind of volatility, you can either embrace it or hate it. And as a trader, you should definitely want to embrace it. At the same time, it should make you, nervous, right? So, I mean, think about it. I mean, it's massive volatility. So things are going on. So you want to, you want to have really good risk management, and you want to have, defined risk. And that's why, I would talk about trading on Nadex. Day like today, things are flying like crazy. Normally, you'd be really nervous to trade. At the same time, you're really excited to trade. So it's one of those days you live for, sort of. And what this can do for you right here is it can allow you to go in and trade with a lot more, confidence would be the best way to put it. Because you're able to, hop in the market right there, place trades, do what you want to do, but not have to worry about just, stops getting ran, not having to worry about, gaps, plunges, flash crashes, limit move days, margin calls, things like that. And you get to have massive leverage. And sometimes the leverage is a lot more. I mean, sometimes it's like 1,000 to 1. Sometimes it's about, equal or whatever. I know one of the trades I was looking at, a trader sent over to me, and on the particular spread he chose, and I wasn't able to see what all spreads were available at that time, but it basically, if he did 10 of the spreads, it would have been more margin than doing a futures contract. And he had a tighter stop loss, and he's like, well, should I do the future or should I do this? And the thing is, he bought 10, but he sold out half on the way. And so one of the nice things is you could go in and, if you want to do a layered exit strategy where you're getting in and getting out of part of the position on a futures contract, you got to buy 2. Or if there's minis, you got to buy minis. But if you're already doing the E-minis, you can't really do less than 1. So if you do 1, it's either exit or don't. I mean, that's sort of your only 2 choices. So either double up your risk and take off half when you get there, or just get out. Well, over on Nadex, you could do, 2, like 1/10 of a position. So you could do 2, which would only be like 20% of the risk, or not even 20% of the risk. So, it'd be 20%, say, the margin or whatever. So it'd be a lot less money you're having to put up to place the trade, but you get the tier out of it. If you have 10 contracts, you could take, 3 off here, 3 off here, 3 off here, let 1 run. I mean, you can do a lot of different strategies because you don't have to do all, it's not all or nothing. It's not get in or get out like on a single futures contract. And yes, the solution is do multiple futures contracts, but that solution also means increase your risk by double the amount. So with this, you don't have to increase that risk by double the amount. In fact, you a lot of times can decrease it, or not have to, no matter what you could decrease it. But you could equalize it by simply having stop losses, or you could choose spreads that are close to the floor or the ceiling. So there's a lot of different things that you can do on Nadex, there's a lot of different ways that you can combine trades, put them together. And one of the trades I was actually looking at right now is in this trade, and I talked about it over with some other traders not too long ago. Just mentioned the idea that I'm playing with right now, and it's pretty cool. It's like you're going into a trade, and one of the issues, this is sort of a new solution because all your orders on Nadex are the limit orders. So one of the issues is trailing stops, right? And you have to basically sit there and have your ticket open and then hit the button when you're ready to get out, because it's going to be a limit order, and a limit order means at this price or better. So if I sold up at 30, let's just say 30.50, okay, and if it gets up to 30.30, I want to I'm sorry, if it drops down, like right now, it just dropped down to 1.3, which in and of itself is going to be a major resistance level. It's a major whole number. So let me pull up. I'll show you a chart right here on the euro dollar. So like right there, we see 1.30 is a major, obviously, I mean, that's just a whole number. It's going to be a resistance all in itself. We just passed the 2 deviation mark. So we got divergences all over the place in different areas. It finally broke the RSI divergence right here. But just that whole number, and you're like, you know what, I'm going to put my stop right here, 1.30. And right now I'm just making up a stop to give you an example. And what do you do? How do you manage that on Nadex? Because you can only do at this price or better. So if you put in an order, okay, to place a trade, and you put in an order to buy at 30.30, well, what's better, buying at 30.30 or buying at 30.20? What's the actual better trade? So, well, obviously, if you're going to buy, you want to buy lower. If you're going to get out on a stopwatch, you want to get out. If you've sold, you want to buy back lower. So if I put in an order to buy at 30.30, they're going to immediately fill me if the market's down at 30.20, and therefore I cannot do a trailing stop and walk away. If I put in a stop above the market, it's going to fill me because it's a limit. It's at this price or better. Okay, so once you understand that, then you're like, okay, well, how am I going to solve this issue? So let's talk about that. Let's go through a scenario. And so right over here, we'll go in and we'll say, okay, we're looking at the Forex bull spreads over here in Nadex, and we're going into the euro dollar, and we'll say we sold. Let's see here, this spread. So I'll pick that one right there. We'll sell that spread, okay, which is 29.10 to 31.60. And for a summary for you, what that means is I can not lose any money above 31.60. I can't make any money below 29.10. All right, and my profit or loss will be the difference between where I sold the spread and where I bought it. So right now the spread is priced right at where the market's at. If I sold at 30.18, the market's at 30.18. Okay, so if I sell at 30.18 and I decide to get out at 30.30, I'd lose 12 pips, so $12. Every spread on Nadex, by the way, always ticks in an increment of 1, and every tick is always worth $1. So that last digit is always the tick. So 8, 9, 10, 11, 12, okay? And that tick is always worth $1. So it doesn't matter if it's Euro Yen, if it's DAX, if it's FTSE, if it's S&P. And people go, how do they do that with S&P? Because S&P ticks in quarters. Well, they make it tick in dimes. So they actually make it tick tighter, which is pretty cool. But anyway, so right here, if I go and I sell that and I want to get out 30.30, if I sold it at 30.18, 30.19, 30.20, whatever, then I'm basically, I have a $10 risk, right? That's how much I'd lose if it went up. And we could move that even higher if we wanted to, right? We could look at different possibilities. So, let's say maybe you have your stop higher. You have it up here at, we'll just say 30.50. Okay, like that. Let's say that's where you got in. Okay? So you got in this trade at 30.50, and, you don't want a winner to turn into a loser, as an example. And, you definitely have to play with this strategy. Like I said, I'm just now working on it. But if that's your break-even point, and it's down here, you're pretty happy. You're at this whole number, but you want to trail the stop, but you don't really want to get out of the trade for whatever reason. And I'm not, I went into psychology yesterday. I'm not going into that right now. But let's see here. Let me bring everything back online. But anyways, hold on one second here. I got a little chart issue. There we go. And so you're trying to figure out exactly what you're going to do, how you're going to do it, how you're going to put it together, how you're going to get in or out of your trade. And So as you're doing that, as you're putting those pieces together, you're also trying to figure out how you're going to manage your stops. Well, you could, as an alternative, instead of closing out the trade or instead of sitting there all day, let's say you just really want to let this one run. And if you can get the trade to the point where you can't lose on the trade anymore, okay, then, you can walk away. Or maybe you just have to walk away, If something came up, you have to leave, whatever, you're still trying to figure out exactly what is it that you're going to do. Then you could put on a spread that's higher, okay? So what we could do, let me pull this up for you and get this back on the screen. I'm sorry, everything on my screen decided to go flat for a second there. All right. So pull all this up for you. And so you could go, well, you know what? If I got in at, and I'm just making up a number here, but let's say if I got in up at 30.50, if I could buy a spread at 30.50 that had a defined low risk, then maybe I could put that on and walk away. And I'm already up quite a bit, so that sounds like a good idea. So we have this trade on, and we're just gonna pretend like we sold at 30.50 at the moment, just to make the example. And I go over here and I open this up. And let's see here. So when I do that, now I'm going to look at, well, I could put this on. If I bought it at 30.50, okay, if I sold it at 30.50, and let's say, put this on right here, it'll make money all the way up. It'll actually hedge my trade-off for me. And so this is a spread right now that's 30.35 to 32.85, okay? So with that simple trade, I'm able to go in, put this trade on, and at least have a break-even in place, worst case scenario. Now, what's the disadvantage of doing this? Okay? And I'll go back and I'll draw all the spreads on the chart for you when we get all done here. We'll actually go through like every piece of this step by step so you totally understand what I'm talking about, because I know a lot of you are new. But, first just to get down the concept and look at everything as it's, moving along, what would be the drawdown of doing this type of trade? Drawdown on this type of trade right here would be that I'd be giving up some of my profit. See right here, the floor is 30.35. So the risk on this trade is $18. So if I'm up, if I sold at 30.50, I am actually taking an $18 loss on my profits. So that's money that I won't make, okay? Because I'm giving up that $18. So if the market keeps going and I lose $18 on this bought spread, and I make $18 on the sold spread, then I'm giving up 18 ticks of profit. So in that one, that's pretty big. I may even avoid that trade just because of that. And so you want to go through and you want to look at what are all the different spreads, what are all the different choices, and there'll be new spreads that come up every hour. And so when we get back from this break, we'll go back and we'll look at a couple other ones, and I'll show you another one that looked really, really good earlier, and how to put that together. So we'll be right back right after this break.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, folks, welcome on back here to the Diagnostic Trading Hour. And so what we left off there, we talked about what happens if you sell a position and you're wanting to hedge it off. And one of the questions I get a lot of times when I talk about the hedge strategy, a lot of times I'll be talking about forex and futures and hedging with Nadex. So, you get to that crucial bell, number. There's about to be a number come out, a news announcement come out, or, you just want to start off like a support and resistance with the hedge. Or you get to a number like this. You get to 1.30 on euro dollar. I mean, if you don't think that's going to be resistance, you're crazy, right? So, knowing that you're coming to points where there could be extreme volatility that could really push it against you, you actually could use a spread to hedge yourself going into that whole number, going into that news announcement. So totally different concept. But instead of simply using spreads to hedge every position, you could do that. Another thing you could do is you could tier in. You go, I'm willing to take a $2 risk on this futures trade. I don't want to. I don't want to lose $100, or whatever. Let's say a 2-point risk would be, $50 a point, S&P, say it's $100 risk. I'm willing to take that risk on the trade. And so you set your stop loss in on your futures account. Well, as it moves up, and let's say you're 1, 2, 3 points in the money, you don't want to, you made $100, $150 now, you're at 1 to 1, it's growing. You don't want to give it all back. And one of those really bad tendencies that we all have, and I was talking about psychology and stuff for the last couple of days, especially we're 100, 150 in, and then all of a sudden it goes against us. And after we've seen it be positive 100, 150, and now we're down 100, but we're like, you know what? It was. I mean, it's just weird. The stuff, the mind games you play, and you saw that green number, and it was bigger than the red number you see right now, and it's down at 100. And you're like, I'll give it another point. I mean, it's just moving back and forth. It'll go back up. Then all of a sudden you're down 150, 200, 250. I mean, okay, if you've been trading for any time, you know what I'm talking about. And it's not good trading. It's not good discipline, but it happens. Well, as it moves in your favor, what if you could prevent yourself from making that mistake? What if you could go, now I don't have to have a stop loss? That's what you could do. While you're trading, you could go in and you could leg into the hedge. So you could start out with the hedge, which is, has cool benefits. But, you have to give up some of your profit immediately because it's got to make back the cost of the hedge. Or you could wait for the market to move a little bit in your favor and then put on your hedge and then remove your stop loss because now you have the Nadex spread making money for you. So you went short on Nadex, you went long on the future, the Forex, or even the spread. Okay, like a bigger spread, a wider spread. And as it moves in your favor, you add a spread to hedge your position. So let's take an example. Let's pull up a couple charts right here on actual Nadex products. And so we're going to go in here and let me see here. I just put a couple trades on. So let me pull those exact same contracts. It'll be a little more accurate to go through and look at, okay, we're in this position. We go through, what do we do? All right, so I had the 29, 10, 31, 60 right there. See, this will load up for me. A lot of times it makes you do it twice. I have no idea why. And like to make you click on that chart button 2 times in a row. And right here. Okay, so you're in this position. The market's moving on down. Okay? And market gets down, as you can see right here, to 1.30. I mean, the low right there is 1.30 to the tick. Okay? And you are nervous. I mean, this is exactly where I tapped my stop. And I literally was thinking about this strategy and typing it to somebody whenever this happened. And I'm like, man, I need to be looking at that. And so I go and look at that, and then I pull it up, and I see this afterwards. Now, I hopped out of the trade. It happened. I moved out. But I'm like, what other options did I have? Because that's one of the things. I mean, it wasn't bad trading. I did well. I traded well. I managed my position. I managed my profit. And I did all that right. So there's nothing that I did wrong. But, I always like to go, is there a way to do it even better? And I'm not talking about trying to overly optimize systems and everything else and, play with your indicators every 5 seconds. But just, always trying to improve as a trader. Well, if you get these contracts right here, here's something you can see. And I'll sort of try. I don't know how much is going to help. But like right there, the floor of this spread, I'll line it up right here, is 30.10. Okay, and here's 30.10 right here on Nadex. So on this spread. So when it comes down and it hits 1.30 over here, then what I'm able to do is actually buy this spread. So I'll go that into more detail. We'll start putting the pieces together for you. But you can apply this to Forex and futures also. So stay tuned. We'll be back right after this.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short-term equity holdings, closing out all 4 positions for a combined 15.9% profit, and on April 1st, Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors.
Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, welcome on back here to the Diagnostic Trading Hour. And what we're doing is we're going in and just, how would you do this whole trailing stop idea? You get a trade here over on euro dollar to go short right here, and the thing's moving down, moving down, moving down. Pardon me. I do apologize. Anyway, so euro dollar is moving down and hits that number 1.30 like to the tick. You should be tightening your stops, okay? So what I want to ask myself, if I'm going to tighten my stop, but if I think, that's I'm not just talking about just a general trailing of a stop. I'm talking about I'm really tightening my stop because I think there's a high possibility of a reversal, but it also could just keep going. I mean, it may break that 1.3 level and just boom, okay? If it does, it's going to break it with passion, right? So I don't just want to get out, but I'd like to be able to ride as long as possible, right? So how much am I willing to give up? Well, if I put my stop out, let's say at 1.30, 20, or, wherever I decide to, put my stop at, and actually looking at this trade, let's see here. What did I do? Because I was actually posting this. 3020. Okay, so that's where I was actually looking at getting out on the trade. So that's where I, set my final stop. And I had part of my position, I actually took it out right here. And the final position I took out at 1.320. Just trying to give it some room to move. So I was willing to give up 20 ticks of my profit because it was down at 1.30. Was there a better choice? If I'm going to go into risk 20 ticks of profit, was there a better choice? And I can go over here and check this out. At that same time, okay, that we're down here at the low, at that 1.30. And it's not just I'm calling the low. That's a major number, okay, for euro dollar. I could go in and let's see here. And yeah, so we'll just do, mid-price right there. So I could go in and I could have bought this for around 30.26 to 30.30. Okay? So, low to high. Well, wait a minute. I'm going to get out, 20 ticks higher. And this is how much risk? It's $20 of risk. Let's just go ahead and go with the 30.30 number. Okay? And what I know it's $20 risk. Well, the floor, and I know it's sort of hard to see it on the TV there, but the floor of the spread is 30.10. So that's why you notice it just has a wall right there, it won't go lower than it. It's 30.10. It can't lose any money below 30.10, no matter what. And since it can't lose any money below 30.10, if I bought it, we'll just say at 30.30, then I am giving up $20 of my profit. Now this is an important differential. Okay, you are giving up $20 of profit when you do this. But if the market is to go against you, you're not out of the trade, okay? Because here's what happens. This spread will start making money when this spread is losing money. So we go over here. Think about this. We're going short, okay? So I'm short on this trade. So I want it to go, I sold it. I want it to go lower. If it moves up, I'm giving up money all the way up. Okay, as it goes up. This one, I bought. So as it goes up, I'm making money. So it'll actually hedge me for $20, risk on the trade. And there'll be multiple spreads, and there's a lot of different ways to do this, and the scanner makes the job a whole lot easier. So the main thing I'm trying to show you is, this may have been a better choice if I really wanted to stay in, and I expected a little bit of a bounce right around here. And, it expires at the same time. And, maybe I thought, hey, maybe it may bounce back up because, here's the 2 deviation level. Maybe can I bounce back up to the 2 deviation and then come back down and test that for a little bit and then just bust through it. And I don't want to miss that bust through, but I really don't want to keep, selling into this thing either. So, because we're so low, if it doesn't go down, I don't want to be selling into a rising market. So how can I remove the ability to have to worry about managing my stop and lock in my profits? Because my profits will be, okay, no matter what, the difference where I sold and where I bought. All right, now that could be higher if I'm, I can limit that that sold spread and it keeps going down. Because remember, it'll stop losing $20 after 30.10 there. It'll have its maximum loss. So as it keeps dropping, then I'll actually be able to, make some money on the other one. It could make money all the way down to 29.10. So it could make money for another $90. And so what I'm looking at on the whole concept, see, this thing's just going up, going up, going up. I'd be giving back my profit right now, right? If I'm in this trade and I sold right here, around 30.50, okay? If I sold right there and it's moving down, moving down, moving down, and now it's moving up, hopefully I took my stop. But, if I didn't take my stop, check this out. This one's moving up, which means this one's making money for me. I'm not out of my trade. It's going to protect me all the way up to 31.10 on that spread or on Forex. Okay, so if I'm short the euro dollar, I could just bought that. I could have just bought that spread, given up a little bit of my profit that I've already made because I'm all the way down at 1.30. So I could easily go, I'll give up 20 pips of my profit. I've made 50. I know 20 is a lot, but this thing could easily fall another 50 to 90 pips. It could fall down to 1.29. That'd be a massive move, but you can't really rule that stuff out. Just look at the last week, right? So, it's already fallen quite a bit today. And so, is it going to fall down to that 3rd deviation level? So just all those little pieces you put together and just something to think about. We're going to get your mind going. They call it, Nadex is North American Derivative Exchange. It's an options exchange. It's not calls and puts, and it's not verticals and, diagonals and calendar spreads. It's not anything like you've traded before. It's more like trading the underlying market when you use the at the market spread. So the spread that's quoting right at the underlying market. And I mean, you can see that right here. I mean, it's quoting at what, 30.45, and you got, your dollar basically at 30.43. So I guess I'll go here and put it on, mid or bid or whatever, to make it match. There we go. Put it on bid, because most charts quote in bid, and so I mean it's quoting tick for tick right there on that spread. So we could be using that spread to trade the underlying market. But I could use some other spreads that are maybe a little bit out of the money, because I remember the floor of the thing's 30.10, the price is at 1.30 when we were looking at this spread, so it's a little out of the money. So there's some time premiums. That's what you're paying for. Now you're only paying for a couple hours, not a week, not a month. People get so excited about weekly options. Like, well, if you think that's exciting, there are daily options, okay? And the sweetest thing about daily options is the Greeks get very neutralized, and so they're really not a big factor. Theta is people go to theta. Well, what about theta? Theta is the measurement of basically the option premium in one day. Well, all you got to do is look at the difference between where you bought and where you sold. The difference is your theta. So that's your whole Greek, okay? And since it's, hours from expiration, then as soon as the euro dollar gets to the same price as where you bought that spread, you're basically going to be moving at a tick for tick level. And I mean, look at this. We're looking at this spread over here, and I'll put, just to make them all fair, I'll put this one on bid also, okay? Right here. And this one's quoting at 30.45, this one's quoting at 30.45, this one's quoting at 30.45. So as soon as we got, where we bought, remember we bought the spread at 30.30, okay? As soon as the market got up to 30.30, this thing was moving pretty much in lockstep with the euro dollar. So this one was already in it because it was at the market. But, you have all these different ways that you can trade. But the great thing is you can go in and you can put up, $100, or you can put up $30 and place a trade. You don't have to put up $200, $500, $5,000. You don't have to worry about you don't manage your own risk and your account blows out and you get a margin call. You can use the floor ceiling spreads and give up some of that premium and never have to worry about getting stopped out. So basically you're doing a volatility-based play. You think the market will move that far. And so there's so many ways you can do it. But I wanted to give you an idea on how to do a hedge on an open position, really a trailing stop in an open position, and how to solve that. I need to step away from my computer. I don't want to take my profits, but I don't want to give them back. What do I do? Well, you can look at, is there a spread that expires at the same time that I can put on where I give a little bit of my profit so that way I don't have to sit there and manage it. So I'm sort of paying for my time, right? That would at least lock it in case the market went in the other direction against me. But if it keeps going, I could still benefit. And that's a way to do that. And you don't have to always put them on at the exact same time on the hedge. Okay, you can put them on at different times. And so this is one way to do that. And another great time to do that, you're in a euro dollar position and the euro has a news announcement coming out. You're in a pound dollar position and the pound has a news announcement coming out. You can go in 15, 20 bucks, you can hedge your position off. Yeah, you're going to give up some of the profit, but if the thing moves 100 pips on you, you got a hedge on. You're okay. And if it does move 100 pips in your favor, you give it 20 of the 100. Who cares? You were able to stay in the trade. I mean, what do you normally do, or what should you normally do, if you're doing indicator-based analysis and you have a high-impact news announcement coming out that will directly affect the thing that you're in? You probably want to get out. That's what you should have been taught. Get out of the position. So don't try to, trade into a number. So what this allows you to do is keep that trade going on into a number, not have any cap on your profit, and have a defined risk. And that's with your current spot trading, with your current futures trading. And of course you can mimic that if you don't want to get in spot, you don't want to get into futures, you don't want to get into the complexity of all that, you don't want to have to open multiple accounts everywhere, you want all your money in the same place, you want to keep it simple, then just use the at the market spreads. But if you want to keep going the way you're going, fine. Now you just have a tool for your tool belt to help you out. So that way, I think that's a perfect example, that 1.3. But, there's several news announcements that came out this morning. And, euro dollar was moving, pound dollar was moving. So I had a great news trade on last night on the pound dollar. And so just a lot of cool things that you can do. And this is one of them. Now, the other one is maybe you're going to play this as support. You're like 1.30, that's a solid number. I think it's going to bounce off of it. Now, if you're wrong, okay, it could fly down and really hurt. But what if you're right and it goes up? Okay, so your expectation is going to rise. Well, you could go in and you'd have to give some premium. Now, this is a way to do this without having to worry about ever getting stopped out, without not even having to take a stop. is I go in and this spread has a floor of 30.10, and I could buy it at say 30.24, 30.25. Okay. When it goes up, I can make money. So as soon as the market gets to the point where I bought it, like as soon as it gets to 30.30, then I'm basically making like tick for tick all the way up. But if it goes down against me and really flies down, all I'm going to lose on the trade is $30. So instead of putting up $200 something in margin and having a 30 tick stop loss or something like that, I can put up $30 in margin and have no stop loss, because it could go 40 pips against me. I'm still in my trade. If it comes back up to where I bought it, then I'm break even. If it goes higher, I make more money. If it, let's say it comes back up to 30.20 and I bought it at 30.10, I lose $10. So but I did all of that without having to worry about ever getting stopped out, and with huge leverage. I mean, it's controlling 100,000 euros. That's 130, or not 100,000. That's 10,000 euros on just one. 13,000 euros, $13,000. So 10,000 euros would be $13,000, and I did $30 to control that much money. I mean, that you need to leverage your money. And I have traders come to me all the time. They're like, I trade stocks. Stocks are cool. Okay, they're fun. There's 20,000 to choose from, and that makes it a little challenging. But there's a lot of ways to trade them, and it's more of a daily thing. I mean, there's a lot of ways to do it. But as far as if you're day trading, I mean, you're not going to beat this leverage. So, and the defined risk with it. So it's not the two-sided. But hopefully that opens up just a couple new ideas of how can I play support and resistance, and where how far do you think it'll bounce? Because that'll be part of your factor. If you're going, okay, if this is like 30.30 and it's at 3, and I think it's going to go, it's going to oscillate up and down. How many ticks? Say 60 ticks on a day or whatever. So if you think it's going to move up 60 ticks, then you go, well, if I think it's going to move up to at least 30.60, and I bought it at 30.30, that's a 1-to-1 risk reward with no risk of a stop. I'm okay with that. So that might work for you. That trade right there, just assuming it's going to hit that point, might work for you. And you could be trailing your stop here too. Okay, so you could be going up, and I have 8-day moving average on here. You could put a, you could trail your stop at the 2 deviation line. So we post those every day for you to check out, and they're up there around 8:15, 8:30 every day. So that way you have access to them for the next 24 hours. And so there's a lot of different ways to put Nadex together. One of the other things I'm looking at, and we'll work on exploring this later this week, is how to even use some binaries possibly as a hedge. And I mean more as a, on that, you're probably not going to be choosing like the 3 o'clock binaries. You're probably looking more at binaries that expire sooner when you're at a point where you think the market may reverse on you. So you're not just going to hop in and hop out on the trade. So with that example, let me go over and I'll just go ahead and pull it up, and we'll do a quick little review. And I like to explore just new ideas as they come up, and you can always call in with any questions you have, and I'll be glad to answer them for you as well. But if we go here to Forex binaries, and we'll go in, like we only have 10 minutes to expiration, okay, right now for the 2 o'clock expiration. So let's look at that. And right now we got the market quoting like right around, 30.40, okay? So the market's quoting at 30.40 right now. But let's say, let's see here. I'm trying to figure out the best way to do this. Stay right there. Well, I'll talk about when I come back.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, welcome back here to the Diagnostic Trading Hour. All right, so one of the other concepts I'm going into right now, and I mean, this trade expires very soon, so it's not the best example, okay? But the idea is as the market's moving down, you put in limit orders. So you go in here and you literally have like a limit order here for, we'll say $10. Now the market's right now at $30, so you're probably not going to get filled on that trade, okay? Unless the market goes in your favor because you went south, you went short on the euro dollar. And so you could do it again here, you could do one at $10. And again, I'm not saying all this math is perfect, I'm just trying to introduce the concept to you. But what you're doing is, there's a lot of different ways you could look at this strategy. I mean, you're making 10 pips on the spread, you're losing 10 pips on the binary if it gets filled, okay? So you're giving up a lot. But if it goes back and reverses, okay, if it doesn't go back in reverse, your spread's covered all your binary risk. So sort of a cool, arbitrage type model. But if it flies back in the other direction, I mean, you could just clean up on your binary, so you get a really volatile day. Also, you wouldn't necessarily have to layer them in every 10 ticks. So you could put one in like every 20, every 30. You could use dailies that are going to be wider. Okay, so like right here, these are automatically 20, ticks wide. And put on different, spreads, different binaries. And you can set it to where you get out at a take profit of $50. You'll make 30, because we always know that the underlying market, if it's at the strike of the binary, will cause the binary to be priced right at $50. For instance, look at this right here, euro dollar, 30.40. So it was basically right there at 44.50 by 51.50. Okay, and so I can know, looking at that, the euro dollar is priced pretty close to 30.40, and this is also quoting at 54. So it's probably right in between 30.20 and 30.40. If I look at it, yeah, it's at 30.34. So literally it's right in between there. And since I know it's going to be at $50, then I could use that as a take profit point to get out of my spread. So, there's a lot of ways I could use this as a way. This is how you would hedge on futures or forks with binaries, is using the knowledge that the binary will be worth 50 when hit. So I just have to be willing to give up that profit, because anytime you put on a hedge, you do give up profit. So insurance costs money, right? So if you want to, if I insure a car, then I have several things I got to do. I got to pay premium for that insurance, whether or not I use it. Okay, I got to pay for a deductible if I do use it. So the deductible is the difference between sort of like where you get in and where your hedge kicks in. Okay, and your premium is the time value. Now, if it blows up, then it could obviously bring you enough to cover a good majority of that. But if you have a car wreck, people say, what pays for my entire car? Well, yeah, but you also paid for your deductible, and you also paid for all your premium. So it paid for your car, but it doesn't mean it was free, right? So you paid for that insurance. That's how insurance works. So it's how it has to work, so they have money to pay you. Otherwise, it'd be like, where's all the money coming from? So anyway, there's one of the ways that we can do is you can go to 30-60, 30-40, 30-20, but you can look at all different things right now, and right now the market's right in between the two. But as you start to learn how these products work, if you'll dive into them and have some fun with them, and you don't have to master every concept I'm talking about, okay? Some of you out there, this is right up your alley, and you're very excited right now. Some of you are, I have no idea what you're talking about, but I do like that idea of getting, not getting stopped out and having really small amounts of money I have to use to trade, and having defined risk, and having leverage with that on top of it. Yeah, I like that idea, but I don't really understand this at all. So, well, that's where you're going to want to go and, learn more, right? So go on over to tfnn.com and sign up right there for a Nadex account. Check out our live workshop coming up. We're going to be coming out to Boston, and our prayers are definitely with all the families out in Boston right now. And check out our tutorials. And I'll see you tomorrow. Stay tuned for another great show.